Hey everyone, welcome back to this course. And today I have a good news for you because I'm giving away 2x 10k accounts with FTUK. Thank you to FTUK for giving out these accounts as well as sponsoring this course. So to participate in this giveaway, all you have to do is to click the link in the description, follow the rules there, like this video, subscribe the channel, and then I'll announce the winners Sunday. Now let's head back into the lesson. So our topic for this video is going to be risk management and psychology, and this is one of the most overlooked concept in trading. I don't know why people don't look at it that much, but this is literally, if you want to stay in the game for longer, this is what you need to learn, and this is what you have to really understand. If we actually talk about statistics, 90% of traders lose money because they have no idea about risk management and psychology. Now, if we talk about psychology in trading terms, it is basically understanding what to expect and what to do in trading. It's actually your ability to control your emotions and be disciplined, while risk management is actually managing your balance and trying to reduce your losses as much as possible. So we have to work on both of these things to actually be profitable in trading, because if you don't have a good risk management strategy, then you definitely are not going to have a good psychology and mindset for trading. Both of them are interlinked, and both you need to understand both of them. Now let me talk about position size, because this is very important and it is related to risk management. So position size is basically how much your position is. For example, if let's say you buy 10,000 euros against a dollar, that means you have 0.1 lot position, or 10,000 euro is your position. Actually, $10,000 is your position. In the same way, if you buy one Bitcoin, that is your position. If you talk about leverage, you put $100 and then put 10x leverage on that. 10 multiplied by 100 is 1,000. So your position size is $1,000 there. Okay, we have to understand position size, because a lot of people get confused in this and don't understand it. So we always have to look at the position size. Then we need to understand where we need to put our stop loss. So remember, we talked about stop loss earlier in this series, and stop loss is basically where your invalidation is, right? So when you put your stop loss and your position size, you need to understand how much you are going to lose on this trade. You have to have that predefined. You have to have your risk predefined. That is basically your risk. When you enter a trade and put a stop loss, whatever amount you are going to lose after hitting your stop loss is your risk amount. So assume you entered a trade with $1,000 position. Okay, I'm not talking about margin. I'm talking about position. Remember, position is the leverage multiplied by your margin. So $100 with 10x leverage is $1,000 position. So assume you entered with $1,000 position, and the market moves down 10%. How much are you going to lose? You're going to lose $100. That's your risk. In the same way, if you enter with $1,000 position and make, let's say, 20%, the price moves up 20%, you're going to make $200 on it. So that's your profit, or that's your reward. So now you understand risk and reward. Risk is basically how much you are willing to lose on the trade, and reward is basically what you are expecting to win in the trade. So we need to always have a risk to reward strategy in which the loss is less than the reward. This is also called RR, or risk to reward ratio. So if we look into this specific case here, I have, these are 5 positions. Okay, this is $100 risk and $200 profit. Okay, these are 5 trades with the same risk amount and with the same reward amount. So if you win 2 trades here and lose 3 here, you're still going to be profitable. Even with a very poor win rate, you are going to be profitable. So take a look at this. Your losses are going to be negative 100 times 3, because you are going to lose 3 trades. But your profits are going to be 200 times 2, because your rewards are $200. So you're going to lose 300, but you're going to win 400 in 2 trade. So your net profit is going to be $100. You always need to have a positive risk to reward strategy, risk to reward ratio. So you can always go for, it depends on your strategy, of course, but you can go for, this is a 1 to 2 RR strategy. 1 is your risk and 2 is your reward. Your reward is double up your risk. You can always go for a 1 to 3 RR, in which your risk is going to be twice as less as your reward. So if $100 is your risk, $300 is going to be your reward. That's a 1 to 3 R strategy, risk to reward strategy. And now you have to understand that position size is going to be dynamic. So for example, if your invalidation is at 10% and you want to lose $100 on this trade, you're going to have a position size of $1,000, right? But if, let's say, the invalidation is at 20%, then what are you going to do? You're going to reduce your position size. So when your position size is $500 and it moves down 20% to hit your stop loss, you're going to lose $100 on it. Now that you have learned this, you are already better than almost like 70% of the traders, because most of them don't even understand this basic thing, the risk to reward ratio. Now, to help you with your emotions, you have to make sure that you understand these things. You have to remember these things, so you have a better mindset and you have a better control over your emotions. The first one is that there is nothing guaranteed in trading. You can win and you can lose as well. There's like no guarantee of it at all. So if you come with the mindset that I'm going to win today, then you are already flawed. Your mindset is already flawed. So you really don't have to do that. Then the second is, do not ever set time-based targets for yourself. From this, I mean, some traders will say, oh, I need to make 10% in 1 month. That's the wrong mindset. Someone will say, I need to make 50% in 1 month. I need to make 2% in 1 week. That's just wrong mindset, because what you are doing is that setting targets for yourself, and assume you're following your entire strategy, but somehow due to market conditions and due to the probabilities of your strategy, you are not able to make, let's say, whatever your target is, assume 2%. Let's say you are at 1.5% and it's the end of the week. Now you have this constant pressure in your head that you need to make 2%. So what you will do is that you will start taking low probability trades, and that will result in losses, and eventually you might even lose your entire profits for the week and go into a negative week. So yeah, and then the next one is, be greedy when others are afraid, and vice versa. So when there is like a very big event in the market, especially global events such as wars, etc., and all that kind of stuff, you need to be really greedy at the time. And from greedy, I mean, you don't have to fear at that time, but instead you need to buy at the time. If you look into Nasdaq or S&P 500 or whichever asset you want to look at, which is related to the United States, you will see that when war started between Iran and Israel, everything went down. They were constantly going lower, but look at them now. Just a few days later, not even a week, and it's already at all-time highs. So that was a buying opportunity. But when other people becomes very greedy, and they start talking about some good stuff, then you need to be afraid. Then something bad can happen, and markets might just go lower. This is how it always works. Then think of every loss as a business cost. So if you lose a trade, that's okay, because that's just part of the game. You can't really control that, and you have to be okay with that. If you are not okay with that, then you are going to revenge the markets, and what's going to happen is that when you avenge the market, it doesn't care at all. You are just going to lose more. So because the markets aren't sentient, it's like, I've given a very good analogy here. It's like trying to take revenge from ChatGPT or any other bot. They have no emotions. They don't care. If you tell ChatGPT 10,000 words, bad words, you cuss them, it doesn't matter. ChatGPT won't care, because it's a bot and it's not sentient. Same goes for the markets. No matter how much you try to avenge it, or no matter how much you get angry at it, it just won't matter at all. And take a look at this. These are the payouts that I shared earlier as well in the beginning. I took all these payouts with a 60% win rate strategy, and I did it all live. I would share the entry, the stop loss, the take profit, everything beforehand in my Discord. And I did it all for literally in front of everyone with a 60% win rate strategy. When I would lose a trade, I would just call it a day. That's it. And that's how I got payouts. That's how I passed challenges. This is why risk management is important. If you go to a prop firm like FT UK, you need to have a risk management strategy. If you don't have that, you will end up blowing that account. And you know what prop firms want? They just want you to be a complete mess. They don't want you to be disciplined, because they care about their fees and all that stuff. So if you want to ace this, you have to trade with discipline. You have to accept your losses. You have to control your emotions. You have to be mentally prepared for all the challenges that you're going to face in trading. And that's how you are going to succeed with prop firms. Prop firms like FT UK, they're going to pay you out if you follow your rules, if you follow your risk management, you follow everything else, they're going to pay you. But if you are a complete mess, you are going to fail at brokers, you're going to fail at prop firms, and there's no way you are going to succeed at trading. So yeah, if you have any questions, please drop it in my Telegram, or you can even tag me on Twitter or slide into my DMs, and I'm going to answer there. Feel free to question, and thank you so much. Goodbye.